In 1974, the stock market was in shambles. Inflation was high, confidence was low. And on Wall Street, the smart money believed only one thing: you needed brilliance to beat the market. That same year, a man named Jack Bogle launched a fund that many in the industry openly mocked. He wasn't promising brilliance, he wasn't promising outperformance, he was promising average. The idea was simple. Instead of paying expensive managers to try to outguess the market, why not just own the whole thing? Low cost, broad diversification, stay the course, let compounding do the heavy lifting. The financial press called it Bogle's folly. Investors weren't interested. His original fund launch raised far less than expected. By Wall Street standards, it looked like a failure. But Bogle believed something radical. Costs matter. Emotions destroy returns. Simplicity wins over time. He wasn't trying to build the flashiest firm on Wall Street. He was trying to serve ordinary investors, teachers, mechanics, pastors, people who didn't need complexity. They needed discipline. Over the next several decades, that foolish idea reshaped investing. Trillions of dollars would eventually flow into index funds. The strategy that was laughed at became mainstream. And here's what was fascinating. Long before Bogle ever articulated it, Scripture had already affirmed many of the principles underneath it: patience, humility, steadiness, diligence, resisting greed. Today, we're not here to canonize Jack Bogle. He was a flawed man like all of us. But we are here to ask, what can believers learn from one of the most influential investors of the last century? Because sometimes wisdom shows up in surprising places. And when filtered through Scripture, it can sharpen the way we steward what God has entrusted to us. Welcome to Plan to Prosper, where we exist to honor God by helping faithful servants steward their finances wisely and build wealth that endures for generations. All right, Logan, here we are. A little bit of a audible that we had to throw. We teased last week that we were going to have a special guest this week, and we had to reschedule that, unfortunately.
You'll see nobody.
Due to the weather, there was just some issues with some conflict of scheduling and all that stuff. So we will have him on in a couple weeks. But today, we're going to talk about what we can learn from some of the world's greatest investors.
We had to reschedule our virtual guest due to the weather.
Well, he the way he explained, he had a vacation schedule.
I
he had to move it up.
I'm kidding.
It was, yeah.
Just
But
sounds
yes,
ironic.
It is a little silly sounding. I almost said world's greatest inventors when I just said that sentence, but we're not going to be talking about that. We're going to be talking about investors.
Yeah. Yeah, a lot of people like to read about these people and their lives, and some of what I've read about at least one of these people, maybe two, is pretty fascinating.
Yeah.
Just about some of the things that they've done and the ways that they did it, and just some stories from their lives. So, yeah, getting to some of that and some of the practical applications and, what we can all learn from it.
Yeah. And so I think the key is none of these guys are perfect. We're just really just trying to pinpoint little snippets here and there of what their overall investing philosophy was, what we can learn from it. And in some cases, it might not be like this massively revealing thing or anything revolutionary. It's oftentimes a fairly simple principle, but nevertheless, I do think they're fascinating people. We've all heard of at least one of these guys. Warren Buffett is probably the most famous investor. Mm-hmm. So everybody's probably heard of him. We'll look at him a couple times in this podcast, and then some of the other ones maybe you've never heard of, and you can learn something from them too.
I like Benjamin Graham more.
Okay, well, I look forward to getting into that. Proverbs 21:5 says, the plans of the diligent surely lead to abundance. And we just believe in sound principles with our finances as outlined in Scripture. And I think some of these guys, I don't think any of them are Christians. Maybe one of them was, if I recall. But
John Templeton?
Yeah.
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 Yep.
What was I going to say? You interrupted me.
You were trying to think of the person.
Well, I was. I said, I don't think any of these people are Christians. And then you
I made no face.
But in spite of that, God does give common grace to all of creation. So whether you're a Christian or not, you actually are a recipient of God's grace. And it's his common grace, not his salvific grace if you're not actually saved. But you still get to experience God's common grace.
So is the common grace here up and to the right?
Yes, exactly.
All right.
All right, let's get into it. We admire principles, not people. All these people are flawed, but nevertheless, we will look at some of these principles and see, hopefully find some wisdom that we can learn from today.
Yeah.
So the first one is about patience. And Jake and I did a whole episode on patience a couple weeks ago when you were in Florida. and the idea that patience over time is going to win more than trying to chase quick returns or get rich quick schemes or anything like that. We believe in patience. And Warren Buffett is a really good example of how he practiced this in his investing life.
Yeah. Warren Buffett's just a kind of a fascinating person in general. I think he just turn like 95, I think. And he just, I think he's officially done now. I think I might be jumping the gun a little bit. He either just had his last meeting or they just had his first meeting without him. But yeah, I mean, he's been doing it forever.
A total legend on Wall Street.
Yeah.
But he believed in just holding great businesses for decades.
Yeah. And some of why he believed that and got into that is because he started his own businesses at a young age, and was kept a lot of details and track of what he was doing. Something I heard was that he had a paperboy route, and he apparently kept such good track and worked so much. He claims he's delivered like 500,000 newspapers.
Wow.
I think that he probably had multiple people working under his paperboy route. I find it hard to believe that one person can do 500,000. But that was what I heard. But that he I think he was like 14 when he was doing this. He was creating his own financial statements for his paperboy company.
That's awesome.
And just really knew all the numbers for his company. So even at a really young age, he was diligent about how he knew his company.
Yeah. Yeah, that sounds like principles that he carried with him into being an investor.
Yeah.
That companies take time to build. Like he probably learned early on from his paperboy business. It wasn't day one that the returns came in right away. Returns being getting paid for his paper route, but that over time, the more that the more efficient he became, the better he got at it, the more money that he could have made. Same principle applies in just any other business that you might invest in. It's going to take a little bit of time, and his principle here is basically like if you're not willing to own a stock for 10 years, you probably shouldn't own it for even 10 minutes.
Right.
There is, no matter the volatility, even when things are looking dire and the stock goes down, your principles should still be the same. Your underlying principles that you believed in from the get-go. Obviously, there may be situations where companies can go under, but over time, just staying the course and holding on to it no matter what the price is doing.
Yeah, and that kind of gets into some different philosophies of investing. Some people would disagree with that approach. I think overall it makes sense for investing. You're investing in a company because I think that it makes sense that you think that it's going to do well, that it's a good company, that you're investing in at a good price and you think will continually grow.
Mm-hmm. Yeah. He just believed that wealth is built through time and discipline. Those are like your two, like the two biggest keys to building wealth are those two factors: is how much time you have and how much discipline you have. Without either of them, it's a little bit shakier. So the two of those together is a pretty powerful force in building some wealth.
Yeah, and he was the kind of guy that really got to know businesses. There was another funny story I heard about where I think the woman's name was like Rose Blomkin or something out in Omaha. Yeah. She started a furniture business in Omaha, and it took off. It was growing well, and Warren Buffett decided to invest in it, and so he invested in it. He actually acquired it, Rose's furniture business, and at that point, she had family members working for her and everything, and now Warren Buffett's the owner of the company, and in her mid-80s, she had a falling out with her family and left the company. The rest of her family is working for the company. She then started a competing furniture company at the age of 95.
Wow.
And a couple years later, Warren Buffett then acquired that company as well. And she kept working there. I don't know how long she lived or anything, but at 95, she started a competing company with her family.
That's wild.
She's competing with her family and Warren Buffett.
Yeah.
And he ended up having to buy her out as well. But he got to know the company, he got to know her, and then so much so that he believed that the company that she created later was worth it as well.
Yeah, that's hilarious. Yeah. I think that's a good. He really believed in simple businesses over complex speculative ones, and we'll get to another one of his principles later that helped in this particular case, kind of his philosophy with what businesses to invest in. That he prioritized and valued simplicity and businesses that made sense to him, businesses that had clear business models over complex speculative ones that, again, we'll get to later one of the principles that helped prevent some level of disaster for him in this principle, where he was able to avoid a major catastrophe in investing because he prioritized more trusted, simple businesses.
Yeah, and I think you're kind of drawing on a pretty good distinction there in how some people invest versus others. Warren Buffett is getting to know the company and values of the numerical values of the company versus speculative investing, where you kind of just think it's going to keep running. Right. You don't really have that good a reason other than it happened in the past.
Yeah.
That the company should keep its growth trajectory going.
Yeah.
Warren Buffett was, I don't know, I think making very educated guesses based on what he saw in financials and products and all of that.
He also was not a big fan of like just excessive trading or anything like that. So this concept plays into, well, if I'm just going to own this company I'm not going to be trading left and right, trying to get in and out and timing everything. It's just, trading might feel productive, but you're adding fees to your portfolio, you're adding taxes situation. So just buy and hold.
Yeah.
Is the idea here.
Yeah. For the most part. He would definitely sell.
Sure.
And he came up with a lot of investors don't have a good kind of exit thesis. He certainly has proven that.
Mm-hmm. Yeah. He said
he does.
Yeah. He said, time is the friend of the wonderful company. A company that's doing well is only going to benefit with more time. So.
Yeah.
Proverbs 13:11 says, wealth gained little by little. It talks about just the steady accumulation of wealth over doing it all in massive chunks here and there. Let's just build it little by little.
Yeah.
I think a key takeaway here is like not panicking during market downturns. I think that's a big proponent or a big aspect of this idea is when the market goes down that we don't panic and sell.
Yeah. Try to remove as much emotion from your own investing and trading as you can.
Yeah. Any other thoughts on patience with Warren Buffett?
I don't think so. All right. We're all set.
So next one, we'll look at the guy that we talked about in the cold opening, Jack Bogle, and his idea of simplicity over complexity.
Yeah.
So what did he do?
He created the low-cost index fund. So probably... Well, there are a couple well-known in the U.S., like the S&P 500 and the Dow Jones Industrial. The Dow is 30-ish companies. S&P is 500-ish companies. And in his mind, instead of choosing what companies you think are going to do best, just buy the whole index, basically.
Mm-hmm. So, but the S&P 500 predates Bogle.
Yeah.
But I guess there wasn't a index fund of the S&P 500 that you could buy into.
Right. Yeah. He's famous for creating that index fund that is just tracking the index.
Yeah. Okay. So he was, I think one of the things like expense ratios were a big priority for him, that a lot of actively managed funds would have higher expense ratios, which makes sense because there's active managers really involved with this. They need to get paid. Whereas an index fund, there really wouldn't be that. It's be tracking this pool of companies that already exists, and we'll just go with that. So the expense ratios or the cost of the fund itself would be a lot lower. So there'd be kind of a twofold benefit here, that you're taking a lot of complexity out, but it's also cheaper.
Yeah, expense ratios and focus on expense ratios is actually one of my biggest pet peeves with investing.
All right, let's hear it.
When you look at a fund, if you're doing it well, you're gonna take a look at the fund the returns of the fund net of fees. And so you're already taking into consideration the fees of the fund by taking a look at net returns, by returns net of fees. So if a fund is doing really well and beating the indexes, but charging 5% and still beating the indexes, shouldn't they be rewarded for the fact that they just are crushing the indexes? I get it that it's expensive, but if you can't beat the indexes like that on your own, why not pay an exorbitant amount if there's consistent outperformance? Now, I think that there are reasons why some funds charge more than others, not related to performance, like a fund that's just starting out. Sometimes you have to watch that. It costs more to run that kind of fund. And that's why a lot of times you want to make sure that you're not buying into a fund that has just started. First of all, you don't know that they have a valid thesis and process and all of that because they just started. But also their fees might be more expensive. But in general, I think there's too much focus on expense ratios because if you're taking a look at net returns, you're already taking into consideration the expense ratios.
Makes sense.
So one quick example, one of the funds, I've held a fund in my portfolio since like 2013. It started in 2008. Its expense ratio is 1.18%. And the majority of the Vanguard funds, that's where Jack Bogle started Vanguard. They're in the majority of them, or maybe not the majority, but like SPY, SPLG, those kind of ETFs that are tracking the S&P 500, not Vanguard funds. Those aren't Vanguard funds, but a lot of the Vanguard funds, VT, VTI, those kind of funds are Vanguard funds. They're in the 1 to 5 basis points, maybe up to 10 basis points. So 0.01 to 0.10%. This fund that I'm holding, 1.18%, has outperformed the S&P 500 since 2008 by 120% net of fees. So again, I think, sorry for my tirade, but I think there's too much focus on fees.
Yeah, what you're saying makes sense. I would just, what would you say to somebody then that comes to you and says, my S&P 500 index fund that has low expense ratio, whatever, blah, 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 has been just crushing it for the past few years. Why would I need to go, like, let's say the fund that's being proposed has been underperforming that low cost S&P 500 fund. Why would I choose one or that over the index fund that's been just absolutely crushing it lately?
Yeah, so that's a good question. I think it depends on your goal for the allocation. So if you just want, for whatever reason, and a lot of times we'll do this in portfolios that we manage, we just want a core equity exposure. And if we just want that, if we just want something that's going to track the S&P 500, then yeah, we'll look for a low cost tracking fund. But it's because we're trying to provide that kind of exposure. We're conscious of the fact that we're not trying to outperform the market with that type of exposure. But it can kind of get into the difference in active versus passive investing. If you're passively investing, yeah, why pay a lot of money to passively invest, to just kind of invest in an index fund? But if you are looking for somebody that can potentially outperform the market, then I think you should expect to pay more fees.
Fair enough. Obviously, we're not giving specific investment advice here to anybody. We're just talking very broadly. But I think in general, whether or not you're buying into an S&P 500 index fund or anything like that, I think the principle of simplicity and I think what I do like about his philosophy is, let's just take the expense ratios out of it, is just broad diversification in the indexes themselves, and the ability to just really have a simple financial plan for somebody that might be doing it themselves, somebody that's not paying a financial advisor. I don't know if it's the wisest move for them to try to be picking stocks and building a portfolio like that. That would be a difficult thing to do. But just buying an S&P 500 index fund, let's just say, again, that's not specific advice. Don't do it if you don't want to. That might be a good move for somebody that's just trying to do it on their own. Yeah,
and he certainly provided a good tool to kind of help democratize investing more, provide the kind of the everyman with a way to better diversify their portfolio than going out and being ridiculously exposed to Apple or Microsoft or anything like that. Just buy an index where you're going to get exposures to that, but at a kind of a more palatable exposure.
Yeah. Yeah. Scripture talks about, again, the wealth gained little by little, or Proverbs 14:15 talks about just some simple prudence in your life. I think just simple wisdom, and not. I think what Jack Bogle created speaks to that a little bit, that there's just a simplicity to this, and this just kind of makes sense. Let's just buy the whole market, essentially. Instead of trying to pick the winners, let's just buy into all of it and just see what happens. Let's go with that. I think that does make sense for an investor that's trying to get started on their wealth building investing journey. I think it makes sense to kind of start there. But
yeah, and I would say that there has been increased progress on doing this in a manner in which, so what a lot of times what we talk against is just buying the whole market, because you're going to end up in companies you don't like. Jack Bogle did a good job of making the whole market accessible. There's been a lot more progress on now creating index funds in which you can also screen for your Christian values.
Yeah, that's awesome.
Yeah.
Great. Any other thoughts on Jack Bogle and index funds?
No, I think overall the principle's good. I guess I'll get into one other principle that you just have to consider I don't know, kind of more the philosophy of investing. Have you heard of the efficient market hypothesis? Mm-hmm. So yeah, Jack Bogle is more of a proponent of the efficient market hypothesis, in which kind of all of the market data is available to everybody, so you can't really beat the market, so just buy it all. I'm not as much there, okay. But I think for, again, large core exposure, it could make sense. But I think that there are ways that you can do research, as Warren Buffett has done. There are ways you can do research and potentially beat the S&P 500 or the index, whatever index you're trying to match.
I love it. Let's go. All right.
I'll try to tone down the investing passion.
No, you're good. Moving on. Benjamin Graham. Who was Benjamin Graham?
He was like the father of value investing, basically. He actually taught Warren Buffett. He was Warren Buffett's professor. He wrote The Intelligent Investor. He wrote Security Analysis, I believe is the name of the book. But yeah, he just came up with a very solid system for valuing companies, creating a margin of safety when investing. And yeah, I mean, I would argue a lot of Warren Buffett's success is probably attributed to him.
Yeah, Warren Buffett said The Intelligent Investor, a book written in 1949, is the best book about investing ever written. You mentioned the margin of safety. What is that?
Benjamin Graham would come up with a price in which he thought a company should be valued, and then he would look to get into the company. So if he thought that the company should be valued at like $100, he would make sure he was getting in at like $80.
Right.
So that even if the market turned against, if the market in general had a downward turn, or the market turned against this company, but his thesis still held, he had that margin of safety where he bought at 80. So hopefully the value isn't going to drop down to 80.
Right. Yeah, so kind of the difference between the intrinsic value of the company, what he really believes the company is valued at, versus what the market is currently valuing it at.
Yeah.
And trying to get in that range, that margin of safety, is buying down here when he thinks it's, values it much, much higher than that.
Right.
He was really a proponent, again, going back to the speculative investments. He really wanted to distinguish between a sound investment and a speculative investment, and make sure that he was leaning more on, just like Warren Buffett was, more sound investment principles as opposed to speculative ones.
Yeah. I think this isn't a recommendation for or against cryptocurrency, but I think cryptocurrency would make Benjamin Graham roll over in his grave.
Yeah, I can't remember. I think it was one of the guys we'll talk about later. I think it was Charlie Munger. That is like, he actually thinks it's immoral. I can't remember. I think it was Charlie Munger that said that. But yeah, a lot of these guys much more traditional.
Yeah, traditional, non-speculative. Yeah, non-speculative as you can be.
Yeah. So this one's a little bit unique in the sense that it's a little bit different than Bogle, where you're. I don't want to say you're trying to time the market, but there is a little bit more timing involved here, where the traditional buy low, sell high kind of a concept here, where you're trying to price get in at the right price in this margin of safety that he came up with. And yet, I don't think that there is. I think we can broaden this principle out of this margin of safety when you think about your own financial life. And the reason why we talk about having cash reserves and having some kind of an emergency fund, you're building your own margin of safety where if things go down or the emergency comes in, you have that additional margin to be able to protect yourself from that. I think there's similar principles at play beyond the investment itself.
Yeah, and there are also, though, a lot of investors that do this within a fund. So as an everyday investor, either DIY or an advisor or anything like that, who's not necessarily going out and buying individual stocks or waiting for a price in which they think it makes sense to buy the individual stock, you can buy funds that will do this and kind of have some potential rotation within the fund in which they're getting into companies that they think provide the margin of safety or are undervalued. Are within a kind of they're deep value investors. So yeah, there are ways you can do this without actually doing all the research needed to actually execute it.
Yeah, and explain a little bit about the way that we invest at Stonecrop. It's not we preach all the time that we're not market timers, that we're not trying to time the market or anything like that. But that's different than finding opportunities to make moves within our portfolio and within our clients' allocations when opportunities arise that see there's a good value here, and this would be a really good move to make right now.
Well, yeah, and sometimes you can go through different market cycles in which it seems like value investing will potentially outperform, and so in that scenario, that's where we'll take a look at benchmarks, S&P 500, Russell 3000, FTSE Global All Cap, and what is the breakdown of value and growth. And if we think that we're heading into a situation in which value will outperform growth, then we will shift more capital into the managers that are trying to practice that value investing.
Yeah, that's great. I think another real world principle that this applies to would be like we've talked about, when you buy a house, you're often approved by the bank for a lot more than probably what you should be buying. Yeah. And so there's this, you're approved for a $750,000 house when really your budget says you should be buying a $600,000 house, or maybe you're approved for a $500,000 house when you really should be buying a $400,000 house. Mm-hmm. You make sure that you're staying within those principles and creating that margin for yourself where technically the bank says that I could afford this, but really, I really can afford this. And you make sure that you're staying within that window so that you're not overextending yourself. And the same thing with investing. You think it's worth here. You don't think it would drop below this, and you're really trying to make that move. At the right time to get the right value out of it.
Yeah. Yep.
Any other thoughts on Graham?
I mean, the only other thought. Both he and Buffett, it's estimated that they both did in their lifetimes. I mean, Buffett's still alive, but we're averaging like somewhere around 20% annual returns, which is just incredible.
Yeah. You're not doing that?
You got to find out.
Oh, all right. Next, we've got John Templeton. What did he do?
John Templeton, he was... He liked to look for opportunity when kind of emotions went against the markets. So like in World War II, he bought up a bunch of really cheap stocks in anticipation that more would come back than not.
Yeah. Yeah, this is an interesting timing in World War II. We're still obviously on the heels of the Great Depression as well. So there's kind of a double, like the Great Depression, I guess, for all intents and purposes was over at that point. But World War II was then going on. And
really the catalyst for bringing the economy back.
Right. And so, yeah, it's not too dissimilar from Benjamin Graham seeing opportunity and seeing value in, wow, these companies, these sound companies are worth this right now. I'm in.
Yeah.
Like, sign me up for that.
Yep.
I also saw that he believed in, and I'm putting you on the spot here, fundamental analysis over technical analysis of stocks.
Yeah.
Can you explain the difference between those two?
Yeah. So the fundamental analysis, again, that would be the same as Graham and Buffett, is digging into the financials, the numbers, the ratios, valuations, all of that for a specific company. And again, coming up with kind of that intrinsic value and making sure that you're not buying when the stock price is above the intrinsic value. Kind of as simply as you can think about it, you're just looking at the fundamentals of the stock. Technical analysis is taking a look at the way in which the price has been moving, and it's like one of the more common ways that some people DIY it is they'll take a look at simple moving averages. So what has the stock price been over the last 50 days, and is the stock price today below or above that 50-day moving average? And if it's depending on kind of the way that the person thinks, they might buy or sell based on that signal.
So it's less looking at the fundamentals of the company and how sound the company is, and rather just looking at what the market's been
looking at the
valued.
price and how the company has been, how the price has been moving compared to how they think it will move based on historical movements.
Yeah. Yeah. And so because of that, markets are emotional, and I think are not a great gauge for how to value these things. And I think he took advantage of that. He took advantage of the market turmoil to really set himself up well after he did all that. And I think the principle applies to us. Like, I think, of course, rocky markets make us nervous. Of course, seeing your portfolio value drop because the markets are bumpy, like, that doesn't feel good. But I think staying the course and taking your emotions out of it, you actually could have some really great opportunities in those moments to position yourself better by seeing them as values, as opposed to just, everything's going down and it's going to continue going down forever and ever, and I'm just going to lose all my money. Yeah.
Yeah. And there was Warren Buffett had a similar approach, and actually I'm probably going to butcher his quote, but his quote was something like, "You should be buying when there's blood in the streets."
Yeah. Yeah.
And so, he had a similar philosophy there as well.
Yeah. I did this recently in my own life. I'm not going to say what it was, but there's a particular investment that had been doing really well for a while and recently has not done so well. And I just, I'm not doing a lot, but I'm like, well, I've avoided it for the past few years because it was just way overvalued. But now the value seems, pretty good. So I thought, I'll just put a little bit in there. I won't say what it is.
I know exactly what you're talking about.
No, you don't. No, you don't. It's just a little bit, just some fun money,
Oh boy!
So we'll see what happens.
The other, real quick, I don't know where to plug this in, but I just love this quote so much. The other thing that Warren Buffett said was, "Only when the tide goes out do you discover who has been swimming naked." And maybe that you can apply that a little bit to the fundamental versus technical. I would say less that, more so against speculative buying.
Yeah.
But yeah, I just, the visual there is hilarious.
Indeed. Yeah. I mean, in scripture, it talks about not being conformed to this world. And if we're just doing what everybody else is doing and panicking when everybody else is panicking and then buying when everybody else is buying, I think that it flies in the face of what scripture tells us to do, but it's not a great investment decision to just follow what everybody else is doing all the time, because that could there was another quote, I had it in a different section, but Warren Buffett said, "What the wise do in the beginning, fools do in the end." And I think this plays into that same idea where you get out at the wrong time and you get in at the wrong time because of the way that you're choosing to do it.
Yeah, that's a good point. And something that we always try to warn people against, it seems like there's this philosophy out there that I need to make a certain amount of money or have a certain portfolio value before I even consider talking to a financial advisor. And sometimes there are cases in which, yeah, you can continue to do it on your own, or you need to get to a certain spot before it makes a whole lot of sense to work with a financial advisor. But I think it always makes sense to talk to a financial advisor sooner rather than later, instead of being Mr. and Mrs. 60-year-old who have $5,000 and want to retire in 5 years,
Right.
And think, all right, we just need to make unbelievable returns over the next 5 years
Right.
because we don't want to work forever. I think to be the wise one is to be the one planning in your 20s and 30s, to not necessarily get to 65 and do nothing, but to not be dependent on your income for your entire life.
Yeah. Yeah, for sure. We're going to move on back to Warren Buffett.
Okay.
He's back. And this time, again, he wasn't a Christian, or he's not a Christian. He's still alive.
Correct.
Okay.
I don't know about his faith.
Yeah.
Correct that he's still alive.
Okay. Breaking news here from Logan. He really, really valued integrity in companies and when thinking about hiring employees, because he was a business guy too. So probably hired a ton of people in his life, probably more than the amount of newspapers that he delivered even. Maybe, I don't know. But he said it takes 20 years to build a reputation and 5 minutes to ruin it. If you think about that, you'll do things differently. We see this all the time. We see tremendous falls from grace from powerful people that made it all the way to the top. I just listened to a whole podcast series about Bill Clinton, and he, made it all the way to being a U.S. president and threw it away because of an affair with a woman.
It's like a stained dress.
Yeah, it's crazy. But it's not that abnormal.
Yeah.
We see pastors that do that. Like, it's a shame. But so integrity is a huge piece of the health of a company, and
self-control.
So exactly. He had this 3-trait rule. This was more specifically about hiring, but integrity, intelligence, and energy. With all three of these, you'll be really cooking with a good employee. But without the first one, the second two will ruin you. If you have if you're really smart and the energy to see things through, but you have no integrity. We saw a lot of this in our financial crimes episodes where people had those second two, where they were really driven, really smart, but they had no integrity. So they were defrauding people.
That's similar. I feel like the more popular, I don't know what the word for it, but there are 3 popular words now that people talk about when hiring, and it's humble, hungry, and smart. But what did you say Warren Buffett's word? Because I feel like it matches pretty well.
Integrity, intelligence, and energy.
Okay, yeah, I think those match pretty well.
Yeah, yep, exactly. So it speaks to moral, ethical behavior, and how you really can't do business without that. I mean, you can, but it may unravel for you at some point if that integrity piece is not there.
Right.
And that speaks again why we believe so much in faith-based investing. We are looking for the companies that are going to be more aligned there and are doing things the right way, that they're not cutting corners. I was also just finished listening to a series on Boeing and the things that they did that caused a lot of their issues in the past 10 years, the cutting corners, prioritizing speed over safety, things like that. We're trying to find companies that are going to do the right thing, even if it costs more and maybe even hurts their stock a little bit.
Yeah, and I actually think that also provides additional reason for diversification, because to that quote about losing your reputation in 5 minutes, you can make a really bad decision for a company that then tanks the stock price, and so it makes sense to kind of diversify your investments to make sure that you aren't so dependent on what one person is doing to influence a company that, if it's 3% instead of 50% of your portfolio, then it's easier to withstand that hit.
Right. Yep, absolutely. I also think it speaks to what we do as financial advisors, why we prioritize our virtues and what we do, our goals in aligning our interests with our clients so that we feel like we can act with integrity without any conflict of interest in doing so, that our interests are aligned with our clients, and clients, we want to earn their trust. We want to make sure that we're honest. We're always as open as we possibly can be with the way that we're investing their portfolios. We never hide anything about what we're doing. Our fees, all of that is just out in the open for all of our clients to see and know at any given time. We want to make sure everything that we do is done with honesty and integrity.
Yeah, absolutely.
Great. Any other thoughts?
No, I think we're good there.
Okay. Continuing with Buffett, this circle of competence. This was one of his, I teased this earlier about how he avoided a major catastrophe in his portfolio. During the 90s and into the 2000s, the dot-com boom was happening, and he was not in on that. He was not invested in these early tech stocks that were just booming in the late 90s. And then what happened? The bubble burst.
Yeah.
And so as a result, like, he avoided that in his portfolio. And it's just really interesting that he's, not that he necessarily saw that coming, but I think a little bit of he did not like the speculation of it. Mm-hmm. Back to the first principle where he was really looking for trusted companies, and these speculative companies were just not interesting to him, and he wanted to avoid it.
Yeah, again, he's much more of a value investor. And in that environment, the investors were, had a lot of the FOMO mindset, and getting into companies with zero revenues, not even zero profit, zero revenues. And his process just didn't let him do it. Yeah,
it's great. And I think being willing to dig into the companies that you're investing in and understanding them will save you a lot, because if you can't explain how this company is making their money, if they are at all, that's probably not a great company to invest in.
Right.
You should probably understand it before you decide to dive into it.
Yeah, and that's what we look to do, or we look to find people that are doing that when we are managing client money. We're getting on the phone or on a Zoom with a manager. And at one point I was on with a manager, and he pulled up his spreadsheet and shared his screen and showed me like exactly what he was looking for with a company. And it was color coded. And if a price got here, it meant, it might be time to buy. And so, yeah, we're not necessarily making those decisions with individual companies, but we're making sure that other investors have a very sound philosophy and process when they're making those decisions.
And this is scriptural, the idea of not being persuaded by smooth talkers. I think the idea is seeing that people in Proverbs, that empty deceivers, smooth talkers, that you use sober judgment when making your decisions and not just blindly trusting somebody because they say they should be trusted. I think it's wise to dig into any dealings that you have with anybody. Even if a friend comes to you and says, hey, loan me X amount of money and I promise I'll pay you back. Well, okay, maybe you want to do that as a friend, as a generosity thing. But if you are genuinely expecting that money back, do you trust that person to do that? Like, I think there's just wisdom in evaluating the things you do, especially with your money, to make sure that you're making the wisest decisions.
Yeah, absolutely. Be a good steward.
Yeah. All right. The last guy is Charlie Munger,
who was taught by Warren Buffett.
So it just trickles down.
Yeah.
Benjamin Graham.
Kind of his, I don't know if that was a teaching, but kind of his understudy or
like
partner.
Aristotle and Socrates.
Yeah.
So what did
Sure.
Whatever. What did Charlie Munger do?
He automated savings. He avoided lifestyle inflation. Nope. He didn't. Yeah. Yep. He did
Yes.
all that.
Yes.
I got lost in my notes for a second.
That's okay.
His thing, he was the kind of one of his quotes was, the first rule of compounding is to never interrupt it unnecessarily.
Yeah.
Which is hard to do. You see people do that all the time. It's one of the reasons that we kind of gauge risk tolerance before we will recommend any type of investment. Like last year, when President Trump announced his Liberation Day, the stocks immediately went down like 15 or whatever percent.
Right.
The broad market, I can't remember exactly what it was, and people were freaking out.
Yeah.
But then a couple of days later, there was a day where the indices were doing 9, 10, 11% in that one day. So people who freaked out went against exactly that rule. Don't interrupt it, because they sold low, and then if they got back in, they got back in at a higher price.
Yeah. Yeah, so he was a big proponent of compounding, the nature of compounding, and he talked about how the first 100,000 in your portfolio is the hardest to get to. And he just some simple numbers. If you were to save $650 a month, which is a pretty reasonable, it's a good amount of money, but a reasonable amount for an average person to save, all in with 401k and different savings revenue or avenues, with a 7% return, it would take a decade to reach $100,000 in your portfolio. So a whole decade to get to $100,000. After the next 2 decades, once you do that, it would take 2.5 more decades to reach $1 million. And so it takes a whole decade to get $100,000. It would make sense that the next 3 decades would another 100,000 here, another 100,000, another 100,000. Yeah. You'd be about $400,000 after those decades. That's not true. The nature of compounding is that you would actually be at $1 million after basically 3.5 decades at that savings level. And he just believed in it so steadily that it was just get through that first $100,000, and then you'll really start to see your portfolio take off and the compound nature take over.
Mm-hmm. Yeah. Yeah, it's not, I feel like when you just think about it, it's not that intuitive, but that's compounding is just kind of cool.
Yeah, very cool. All right. So these guys were not perfect. They got some things wrong. And we certainly want to at least address some of this, that we're not advocating for just, and we've talked about this a ton of times, but just building wealth for the sake of building wealth. We're not talking about greed here. We're not talking about just like trying to get one up on everybody or beat the market so that we can have any kind of pride in that or anything like that. We're just trying to utilize sound principles from Scripture, and we see these guys doing some of that in some of the way that they invested. Yeah.
Yeah. And I think not getting too hung up on returns. Part of the reason I didn't answer your have I personally done 20% is because I don't know. I can't remember exactly what I've done. I wonder if many of these investors do know exactly what they've done, or if they've just been told. I mean, I can give round figures for what I think I've done, but yeah, I wouldn't know.
I only asked you kind of as a joke. I wasn't expecting you to actually answer the question. But yeah, that makes sense. Not tracking it so religiously, because I think that demonstrates where your heart is a little bit too. If you're just like obsessive about it, and it's not just like, yeah, this is just happening behind the scenes, which is kind of what we would recommend, is just you should be prioritizing it and you should be diligent in it, but not obsessing over it on a daily basis to the point where it would in any way give you anxiety and stress when the things are bumpy, or unnecessary, like, look at me when things are up. I think we hold our finances with an open hand, because God can do whatever he wants with it. And wealth does not mean you're a righteous person. So there's no correlation between money and righteousness. If anything, 1 Timothy 6:9 talks about how the love of money is the root of all kinds of evil, and those who want to get rich fall into many temptations. Well, we should be really careful then how we do this, so that we're not falling into those temptations, and we're making sure that as we do this and as we utilize sound principles to try to accumulate wealth, we're not doing it in a way that would cause us to fall into these snares that so many people clearly fall into. And we're maintaining holiness, and we're maintaining our relationship with the Lord, and we're not putting our trust in the money itself, but we're maintaining our trust in God as we try to be sound stewards of our finances.
Yeah, and even more than just finances, if I became so obsessed with beating Warren Buffett's returns, and that's all I ever tried to do, I don't think I would be a good steward of everything else I've been called to be a good steward of over just my finances. I would probably 24/7 be trying to create a system to beat him, and I would be a bad husband, I would be a bad dad, I would be a bad all of that. And so while it might on paper look like I was a good steward of my finances, I would argue I just screwed up everything else.
Yeah. Yeah. And how many super wealthy people have we seen ruin their personal lives because they did just that. They were so obsessed with their career and their wealth and all this stuff that they ignored everything else that was important to them. We don't want that at all. We talked about that in our balancing episode last week, that you balance everything in your life appropriately because you can't just lean too hard in one direction. You can't spend, as important as prayer is, you can't spend 24 hours a day in prayer. You just can't. There's other things that God is calling you to do as a person, to be a good husband and father, be a good mother and wife, and be a good child.
And including how to interact with him.
Exactly. Yeah. So there's so many factors that you need to be able to, even good things, you can go too far in them and make it difficult and at the expense of other people.
Yeah.
You only have 24 hours in a day. You need to allocate it as best you can.
Right.
So practical takeaways: save consistently.
Yeah. Save consistently. Avoid the market hypes of what the next best thing is. Nobody knows the future. So invest in a manner in which you understand.
Yeah. Invest simply. It speaks to that too. I think.
Yeah, maybe. I like some of the more fancy stuff.
That's fine. But I think for an average person that maybe doesn't know,
trying to do it on your own,
is not a CFA.
Yep.
They might need to pare it down a little bit and keep it simple. Keep it simple, stupid.
Yeah.
Protect your family. Make sure you've got insurance. Like, are you prepared if you were to pass away suddenly and you're the main income earner in your family? Are you prepared for that? To take care of your family? That's an important principle too that we didn't really talk about insurance at all in this, but there's principles behind that too. Yeah,
but if you follow the Charlie Munger compounding, you might also be able to self-insure.
There you go. We also think you should, back to the integrity thing, align your investments with your faith. There is a way to do that now, and that's what we love to do at Stonecrop. Talk to us if you are interested in hearing more about that and how we do faith-based investing to help Christians get their investments into companies that are going to be more aligned with what they believe in.
Yeah. We're I think continually trying to democratize that part of the industry, just make it more available and more innovative for everybody.
Yep. We believe in patience and discipline. Time and discipline are your two biggest friends in investing, and take it little by little. Don't try to get as much as possible in a day, but let's just build a little bit at a time.
Yeah. Can't believe it, or I can't remember if it was you or Jake that said it. And I can't remember if it was on a podcast or not, but did you have the tree quote?
Oh, the best time to plant a tree is...
It was like, however many years ago or something.
10 years ago, the second best time's today. Yeah. Come to us for more Chinese proverbs.
It was one of you. Maybe, I can't remember. I just know it wasn't me. I heard it though, and I liked it.
I'll take credit for it. Thanks for listening. Tune in again next week, and God bless.
God bless.
Investment advisory services offered through Stonecrop Wealth Advisors, LLC, a registered investment advisor with the U.S. Securities and Exchange Commission. This material is intended for informational purposes only.